Hey everybody, this is Patrick Zielbauer from Infinity Futures. It's 3:30 on Monday, August 28th. Welcome to our go-to meeting room. In this event, we're going to be talking about the Sierra chart program that we offer here at Infinity and support. I'm going to talk a little bit about some of the ideas that I have of the market and show you how you can use Sierra to, sort of rebuild something like this as a sort of like an example of how you can build your own series of filters. So you don't necessarily have to use what I use. You're welcome to the files afterwards. I'll give you details on that in a minute. But first, let's go through some risk stuff. So trading futures, options on futures, and retail off-exchange foreign currency transactions involves substantial risk of loss, and it's not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. All right. If you have any questions about where you fall on the risk capital curve or if futures trading is appropriate for you, please feel free to have a discussion with your representative here at Infinity about that. That's something we will speak very candidly on. We talk very objectively when it comes to risk, and we don't sugarcoat it. All right. My name is Patrick Zielbauer. I'm an AP or associated person of Infinity Futures. I've been working for Infinity for over 13 years, and during that time have supported and sold and used a ton of different trading platforms, different data feeds, different clearinghouses, all different products. And one thing that if you're here, you probably know is that Infinity spends a lot of its resources and efforts and time in supporting and using Sierra chart. So before I get into the presentation, I just want to highlight this. For those of you who are wondering whether or not Infinity might be a good fit for you, if you do a minimal amount of trading with us, we define that as 10 round turns every 30 days, then we will waive the fee that we would otherwise charge for the charts, which is $19.95. So using Sierra through Infinity is very cost effective because we charge less than Sierra charges on their own. And we offer it free if you do a little bit of trading, which you probably will if you're going to be opening an account. And we do great support for it. And one of the things that I have, I would like to mention here, and I firmly believe this, and this belief is reiterated on pretty much a daily basis, is that nobody supports this program as well as we do. The relationship between Infinity and the management and owners of Sierra is unique. We listen to a lot of feedback. We take lots of input. We are constantly improving this program. This program is, in my opinion, by far the most improved product in the entire trading world in the last 5 years, and especially something available to retail traders. It's just 10,000% better than it was when we first got started with it. I firmly believe that. So hopefully we can illustrate why that is today. And I want everybody to consider this a very open environment. And the reason why is that I don't have a magic system to sell you today. So you can disarm. All right, you're not going to be sold some magic thing at the end of this deal. It's just our charts and our trading platform. You're here because you're interested in our charting or you already use it. So hopefully we can provide some value here, and you can make the decision if you're not already a customer of why this might be a good reason to come here. And if you're already a client, hopefully this can reiterate to you why you are here. And I hope I can demonstrate today the lengths and the amount of effort and time we put towards trying to keep our clients around. That's really what this is all about, longevity. So that's something I firmly believe. I really appreciate the comments. As far as kind of how to organize this event, it's a little tricky because I'm going to try to be rebuilding something in real time while we're going through the charts. That means that I can't really get off track too much because otherwise we're going to go way too long. That doesn't mean we won't do another event like this in the next Monday or the Monday after that, but I do want to kind of keep it moving. So I'm probably going to hold on the questions until a little bit later. And then at the end, we'll try to do some Q&A. So I hope that's okay. That's not how I normally do it, but I really want to try to stay on track and stay focused. Okay, so let's go ahead and just get the charts up. So I'm going to minimize the browser here, and what you're going to see on the trading platform on the screen is 4 charts next to each other. You're going to see our scoreboard in the back right corner. That's like our trading platform portion. You don't really have to worry about that at this moment. We're going to focus a little bit more on the charting today. And what I really plan to do is explain, what I need to do first is explain what we're looking at and why I look at it, and then we're going to rebuild it. All right, so let's just pretend we're focused on one market for now. So all these studies are all identical across these four indexes. You have the S&P, the NASDAQ, the Dow, and the Russell. So let's just pick the NASDAQ for now because that's been kind of the outlier lately. It's been the fun one. We've been doing a lot more business in the NASDAQ because it's been very volatile. So let's just touch on this briefly, and then we'll go back and we will essentially rebuild the screen from scratch as close as we can. And we do have a replay, Ray, that will be made available on YouTube, hopefully within a day or so at the most. All right, so let's get started. So when we look at the NASDAQ chart here, I want to first explain what's at the top portion, and then I'm going to explain what's at the bottom portion. So on the top portion, we've got a 5-minute chart, and we have some red and black dotted lines here. You see, I'll explain those in a moment. And then you see a bunch of values in the y-axis that are highlighted. I'm going to explain all of those as well. And then you see basically some moving dashed lines, like this green one up here and this red one down here, and then some solid ones. So let's start with the easy stuff. In the y-axis, you've got a study that shows the current high. You've got the point of control, the value area high, and the value area low. So this area between the solid green and the solid red line is considered the value area. That means that 70% of the contracts that have traded today are in between these two ranges. This is what's called volume value area lines. All right, so it's not as concerned about time as it is actual contracts traded. And then you've got some other figures like the previous low, the low of the day, and we're going to show you how to add these studies. But these are just benchmarks. Previous high, the high, value area high, volume point of control, value area low, previous low, and low. All right. Then you've got this black dotted line here in the background is crude oil. So we have the price of crude oil on the screen, but we don't have a separate chart visible right now, although there's one running in the background that shows the price of crude. And then the red dotted line is the price of bonds. That's the 30-year bond. This moving green dashed line is what's called a developing value area high. What that means is that the current value area is shown by this solid green line at the top, but the dashed line is what it was when the market was back here at this time. So I'm going to put the crosshair on for a second. I don't normally use the crosshairs because they give me a headache. All right, so I'm not going to leave them on for long, but like the value area high here at this time at 1:25 p.m. Central, this is where the value area high was. The green line is where it is now. So you don't necessarily have to have the value area high and the value area low on as developing lines if you don't want to. But when I go back and look at some of this stuff, I like to see where they were when my signal was triggered instead of just where they are now. That's why I have both. All right, so we've got the value area high, the value area low, and then you've got those same values except they're developing. So notice that they converge. So at the current moment, the developing and the actual lines are the same. That's why they're kind of on top of each other here. All right, and then the gray background color, we'll touch on that here in a little bit. All right, that's not always going to be there. And then you've got a volume profile here that is a weekly profile. I'm going to go through the studies list here in actually just in a minute. Actually, let's come back to that in a minute. But this is a weekly profile. I confused myself for a moment because it's Monday, so the weekly profile looks the same as a daily profile. But this, if this were Tuesday or Wednesday or Thursday, you could see this profile will extend above and beyond the lows of today, assuming that the market had, traded higher or lower at some point during the week. So it's a weekly profile. It's Monday, so it looks like a daily profile. Okay. And then let's go down to the bottom of the screen. So I'm going to move the quote board out of the way here. At the bottom down here, we've got a CCI. Okay, we've got lines on the 200 and negative 200 levels. We have a bid volume and ask volume chart, which I'll explain its significance later. And then I've got a line here that represents the percentage change of crude oil today. So this line is graphing not just crude, but it's graphing the percentage change that crude has undergone today. And as you may know, crude was down about $1.15 or so. So it was down about almost 2.5%. So that's why we see this value here. All right, so that is what we're looking at on these screens. Now you'll see that at some points, the background is not gray. It's actually just the white color. And what that is, and I just want to double check the percentages here in a minute, and I'll explain what they are. Right, okay, so what this here is, this background is turning gray only when the price of, when crude oil is down more than 1% that day. So it's, otherwise it's going to be white. So when you can see here, when crude started to break down this morning, that's when the background of the screen turned gray, and it's going to be gray anytime the crude oil market is down more than 1%. That number can be easily adjusted. I've got a couple of reasons why I incorporate this. I'll explain those here in a bit. Okay. All right. Now, what I want to also do is just scroll back a bit, because when we scroll back a bit, you're also going to see some other lines come up. You're going to see these like green, or excuse me, these red lines and arrows pointing down, and then blue lines pointing up. So you'll see right here, this red arrow pointing down and this red background, these are the same signal. I only put them both on at the same time because some people are really partial to the arrow and some people are really partial to the background color. So the only reason I put them both there is so that you can see them both. All right, so this would, in this case, let's use the term sell signal, okay? I'm using quotes around that because there are times where it's clearly not, but we'll explain that. And then this would be like a buy signal. And I'm going to explain, why they're showing up as well here in just a moment. Okay, so you're going to see those on all these charts. If we were to go back in time, you're going to see several instances where those lines are occurring. All right, now the general theory behind this way of looking at the market is this, is that this oscillator, the CCI, doesn't trigger a 200 value very, very often. And when it does, it doesn't hang out up there. So very rarely do you see a CCI close over 200 value or less than negative 200. So that is what I would consider to be sort of an anomalous event. And that's using the term quite liberally. But the idea is it doesn't happen constantly throughout the day in most cases. Usually it oscillates at levels that are less than 200 or greater than negative 200. But every now and then it hits 200, okay? And what you'll also see is that periodically the market breaches its value area high or breaches its value area low to the downside. And what that is saying is that the market is now trading outside of the range where it's spent the majority of its trading so far. So a lot of times what you'll see is when the market breaks through a value area high, there's a flurry of interest or activity. Value area, as I mentioned earlier, in this context, this is based on volume. It means that 70% of the contracts have traded in between these two prices, this solid red line and this green line. So when the market goes outside of the value area and the CCI triggers that negative or positive 200, that's when the signal comes. Like this, right here. So here's an example of the market breaking down. This was this morning, very early this morning. So here's the market going lower, hitting the value area low, going through it, and at the same time the CCI is spiking to negative 200 or greater or less than negative 200. So it's going below negative 200. That's what generates this blue arrow. So on its own, if you're just like following this without any sort of context whatsoever, it's like, oh man, that was a great buy signal, but it doesn't quite work that way all the time. This is arguably could be considered a counter trend or fading strategy, where if you were to follow it exactly, you are almost always buying the market when it's going lower, and you're always selling it when it's going higher. In this type of a market where people, if they don't buy now, they probably should have developed at some point over the past couple of years a long bias. Okay, if you have a short bias in a market like this, which traders tend to have, and you're not paying close attention, this can get you in trouble. So it's important to understand the context of what else is happening in the market and be watching the other indexes and other indexes as well, excuse me, for clues as to whether or not this is like just chop, which is great for this type of strategy, or if it's a trending market that's going to continue all in one direction the entire day, which is horrible for this type of strategy. So in my opinion, this type of strategy where you're looking to sell strength or buy weakness based on this oscillator breaking this level and the value area being breached to the downside or to the upside, this strategy is best for someone who likes to trade when the market is not trending, but gets chopped up in choppy markets. So this type of a system could work great if the market is very choppy, because it's doing exactly what a trending trader doesn't want it to do. It's breaking a little higher, it's weakening, it's going a little lower, then it's breaking down, it breaches that value area low, the CCI spikes down for a little bit, then it rallies back up. That's a perfect world. So if you find yourself, if you already can identify very well when we're in the middle of a choppy market, this could be a great addition to your arsenal. Okay, if you struggle with trying to identify when something is like seriously trending or not, you might want to be cautious of something like this. All right, now the reason I have crude oil so heavily in the mix here is when I first started looking at crude, or at this idea, crude was in the low 30s. So every time crude started to break, the market would go with it. Right now, crude is, as you know, closer to $50. It's not as big of a day-to-day story, but you can bet that if crude does break down closer to $40, that it's going to start being relevant to the stock market again, because a lot of energy companies are in the S&P 500. Right? So what this system is doing is it's trying to keep you out of bad long positions when crude breaks lower. That's why I have crude oil on the screen, and that's why I want to know automatically if crude is down or up on the day very quickly. And I really want to know it without all this extra nonsense at the bottom of the screen. And that's what we'll sort of discuss here, how to do something like how you can accomplish that, because that's really what the goal is, to simplify everything, not to keep all this stuff on the screen all the time. So if you're hypothetically speaking, if you're looking at the market and all of a sudden you see a great, long signal in this type of situation where it looks like it's kind of a choppy market, there hasn't been a determined trend, and the market breaches that lower value area level down here, and the CCI spikes lower, and you're thinking, oh, that's awesome, let's buy. But you see crude is making a new low, that's a good reason maybe to stay out of the long, or at least give it some room to work lower before you get long. And so that's why I had crude oil so centered on this screen with the background color, with the black dotted line here, and with the percentage change. So again, this was a little bit more relevant when crude was like at $35, because every time it would break lower, had I had crude on the screen at that time in a way that it is now, I probably would have stayed out of some potential, bad losers, which were great technical entries, but they were just getting rolled over by the fundamentals of crude hurting the stock market. So that's why crude is so centered on this idea, but we don't have to have, as crude becomes less relevant when it's around where it is now, $45, $50, you can hide it very easily off the screen. All we have to do is check a box and you don't have to worry about it. So we can easily hide it. And then if crude starts to break lower to $40 or so again, then you can put it back on your screen and use it to keep yourself out of some potentially bad longs. All right, so that's a brief explanation. Now there's a couple other little things that I just sort of recently added that I'm still experimenting with, and frankly I haven't had a lot of success with it, but I did want to highlight them anyway, and that is there are a couple of little blue dots here, and sometimes you'll see a pink dot above like this over on the RTY chart. And what that is looking at this bid volume versus ask volume study. And what it's doing is it's telling us when the bid volume or the ask volume is eclipsing the opposite, the bid or the ask volume by a factor of 3. So if the bid volume has traded 200 contracts, but the offer volume has traded 900 contracts, then you get the blue arrow or the blue dot, which basically says there's way more volume hitting the offer, which is arguably bullish from in a textbook standpoint. Conversely, if the bid volume is way, way, way bigger than the ask volume, that's arguably bearish, and that's when you get the purple dot. And so I put that in place to allow people who are into order flow see that there are things you can do with this program that are very, very basic, where you can easily see this happen in real time and use it to sort of fine tune your entries if you follow order flow, because order flow is a big buzzword in our business right now. It's order flow this and order flow that, and there's as I mentioned in the description of the event, there's like $5,000 indicators you can buy for some of our competitors. It's just, to me, silly. It's just not necessary. There's so much you can do in this program if you know what you're looking for. All right, so does anybody have any questions on just like the guts of the idea before I get into some of the mechanics and start going through how we might be able to rebuild this? Because I know we took a little time here going through this. I just really wanted to put it in the proper context. Lou, regarding your question, I'm going to build this here from scratch in a second, so we're going to have it on its own screen. So hopefully that'll be a little easier to see, okay? Ed, the CCI values really are nothing fancy. It's a 200, 200 up and down, and then a length of 10. Nothing, simple moving average, regular inputs, no real impact there. Ted, what about prior value areas? There's really not any consideration given to prior value areas, but I could easily see how that could become relevant in something like this. Okay. Manny, the green line, is it also called the VWAP? No, it's not. It's not the VWAP. The VWAP stands for volume weighted average price, which we'll show on another chart here in a few minutes. But we'll get to that here in a little bit. All right. Yeah, Robert, I'm going to make this from scratch here on a bigger screen in just a second, so just hang tight with me for that, okay? The volume point of control is, so this line here, this blue line, is the price at which the majority of the market, the majority of the volume has traded at in this session. So that's the volume point of control. All right. Okay, so let's go ahead and try to let's go ahead and try to build this from scratch here, and I'm just going to go through some of the basics and then some more of the fun stuff, and then we'll come up with some more questions and go from there. So, and again, and one thing I should mention too is that anybody who wants a copy of any of these studies after the fact, just email your rep in our office. We'll make them available to everybody for free. And at the end, I'm going to touch on some other things that you can do with the order flow stuff, the profile, a couple of volume profile samples. I'm going to talk briefly about this spread thing that we're working on as well. But anybody who wants copies of the files to use on their own, feel free to request, okay? All right, so the first thing I'm gonna do now is just go and open up a new chart book. So we just have a brand new chart book, nothing in it. And we'll go to find symbol. I'm gonna open up, let's use the NASDAQ since we were using it before. So I'll just do NQU7 and open up the chart. All right, now when I look at a new chart, the first thing I like to do is I like to look at the session times, because I like my start times to be the actual open, which for me is 5 o'clock, and then the close to be the actual close, which is for me 4 o'clock. Okay, so that's 1700 hours, which is 5 p.m. Chicago time, and then the end time is 1600. The reason why this is relevant is that if you're going to use studies that rely on things like the daily open, high, low, close, and that sort of thing, I really like to look at the entire session. So I want the start time when the chart is calculating things based on the open or the close and that sort of thing. I want them to be based on the actual session. So I just apply that change. And then something I also like to do is I like to put a little space in between the current bar and the y-axis. And I just do that by just creating the desired amount of space with the mouse, and then right click and just choose lock fill space. Okay? Hey, Ted, with respect to your comment, Ted's comment is market profile totally requires the prior day's value area. And I totally get that, but I actually am not using market profile. I'm using volume profile. So everyone's got their own spin on it and their own way of looking at things, right? So this is just my way of looking at it. I'm not saying it's right. It's just what I choose to use. So you take it for what it's worth, my friend. It's totally, it's for your benefit. All right, so once I have that in place there, I just right click and choose lock fill space, and you can see that lock fill space is on by looking at the capital L in the bottom right corner here. So when you look at a chart very quickly, you can see that capital L is engaged. All right, now from here, what I like to do is start with the simple stuff. So I'm gonna go ahead and add the CCI. So I just right click and go to studies, and let's just add the study called Commodity Channel Index, like this. And if I just apply this without really doing anything, it looks really weird because this is just how the defaults are in the program. One thing you can do inside Sierra Chart is you go into the settings section and you can very easily and quickly edit the behaviors and the inputs of each of the values. So I'm going to change mine to 200 and negative 200 for the lines. I never really made any changes to any of this other stuff here. And in the subgraphs, what I like to do is make the CCI just a blue line. I like to use a draw style of a line instead of a bar because it's just easier for me to see, and you can thicken up the line a little bit. You can put the value label on so you can see the actual value in the y-axis. And then if you have a color preference, in this case we're using a white background, I just might make these colors here black. And I know I'm kind of going through these little trivial things. I know they're important, but a lot of this stuff you can do after the fact, and we have other videos that cover, little things like this, okay? So there's our CCI. So we've got a CCI here with the lines at 200 and negative 200. You notice when you put your cursor where one region meets the other region, you can see that there's a little line that shows up there. You can grab it and drag it down to make it bigger or smaller, like that. This is a little bit more helpful when you have lots of things on the bottom panels. All right, so let's go back and look at our main one here. We've got the CCI there, so that's good. All right, now the next thing I'm going to do is add that bid volume versus ask volume study. So this is a little bit of a different order than I originally built the first one, but it's okay, we could still use everything. So I'm going to right click and go and look for that study, bid volume versus ask volume, right here, and just apply it, see how it looks. Okay, it looks okay. I'm going to definitely make some changes. So I'm going to go here, thicken up the bars a little bit. I'd like to see those value labels because I really want to see the value in the y-axis, and I'll just make that zero line black. I actually hide this difference. This difference line shows like the delta between the bid volume and the ask volume. That certainly is useful in lots of cases, but in this case here, I'm just not really paying that much attention to it. All right, so now we've got that study in place. All right, so we've got our CCI, we've got our bid volume and ask volume. All right, now let's go back and look at our other panel. The next thing down there at the bottom is the crude oil. So this is where things get a little bit more fun, okay? Because what we need to do is we need to have a crude oil chart with that percentage change study on it in order to overlay it onto this chart that we're looking at here. So what I'm going to do is open up a crude chart, and the current symbol for crude is CLV7. So I open it like this. All right, I'm going to restore it down so it's not taking up the whole screen. It certainly doesn't need to take up the whole screen, and really ultimately it's going to be minimized. But I'll just put this here in the corner so we can see it. And on this chart, I'm going to add a study called the percentage change. This is another chart that's really important if you're going to use things like percentage change since open, that you really need to make sure your start and end times are proper. So I'm going to double check that here in a second. So here's the percentage change. Let's make it black, zero line black, and then let's add that value label. Okay, so there's the percentage change of crude. All right, that looks good. So what we can do now is we can use another study that we've got on our main window called study price overlay. So I'm just going to go down the list here until we find that. Study price overlay is probably one of the most powerful features of the program, where we can add the study, but unlike a moving average or something really basic, we got to really give this thing some inputs. And the way to do that is you go into settings, and the most important input is this first one right here, study to overlay. So when you click on it at the bottom, you get a listing of all the charts you have open in this chart book. So I'm going to choose the CL one. And over here it says, okay, what are we overlaying? Well, we don't want to overlay the main price graph in this case. But we do want to overlay this percentage change since open. So I just select that. And the chart region is 4, which is smart, and it's smart enough to put it in 4. So this is chart region 1, this is chart region 2, this is chart region 3. So it's assuming that we want it in the next one down, which is fine. And let's just apply that, and you'll see very quickly we now have the percentage change of crude on our NASDAQ chart. So at this point, we can really minimize this percentage change chart. We don't really need it up on the screen. It just has to be open, so don't close it, and just keep it open. But just if you want it out of the way, you can minimize it. All right. So if we go back and look at our original panel here, you'll see that we got the CCI, the bid vol versus the ask vol. We got the percentage change. So we got all our panels at the bottom. So now let's work on the top portion. All right. So what I'm going to do now is let's do the overlays. So this dotted line here, the red bond one, and the crude oil overlay, let's get those up there. And these are actually really easy. And one of them with crude, we really already have the other chart open. So we're going to use that a second time. So we have another study here. For those of you who do like to do something that's really simple like this, where you're just overlaying one market onto the other, you just go to overlay single line. I like to use a single line. You can use a bar if you want to. Non-sync is when you want to overlay something from like a 60-minute time frame onto a 5-minute time frame or something. I'm not really using that in this case, but I'll go to overlay single line, click on the add button, and in the settings section, as you'd expect, it's going to ask you, okay, well, what are we going to overlay and where? So I'm going to overlay the 5-minute. I'm going to change the region in this case to region 1, which is the main price graph. And in the subgraph section, I'm just going to do some colors. So let's just make this black. I think I had a dotted line, value label, we push apply, and there's the price accrued. So this price, you see, is being pulled from this other chart that we had open down here. So it's just going to overlay it. As long as this one down here stays open somewhere, this one will be active. So we now have the price accrued on the NASDAQ chart. Good. We also had bonds visible. So in order to get bonds, let's go up to find symbol. We're going to open up ZBU7, which is the front month for just a couple more days, I think, of September bonds. And really for this, I'm just going to squish it down in the corner again and minimize it because we don't really need this to be visible right now. We just need it to be open. And when you have a study like the one we've done with the overlay, something like this, you can actually just push this duplicate option. Okay, so I'm just going to click on it and hit duplicate, and then go into settings and change the chart number that we're overlaying from crude to bonds. We're going to leave it in region 1. Going to go ahead and make a change to the color scheme here and push apply. And there's bonds. So we now have the overlay of crude. We now have the overlay of bonds. We've got all our panels at the bottom. So we're making some progress. You can overlay all 4 indexes in one chart as well. You can use this overlay as many times as you want. So if you want to have one base chart that has 10 or 15 other commodities, that is possible. You just have to repeat this process a few times. All right. Okay, so now the next thing I want to do is let's touch on just some of these, and I'm not going to memorize. I mean, I'll try to get all the colors right, but previous high, the previous low and low. So those are just benchmarks that I like to look at just because usually you see a flurry of activity, around those values. So that is done using a study called daily open high-low close, daily OHLC. So in this chart book, what I'm going to do is go ahead and add the first instance of that. So I'm going to go down to I like to go to the bottom of the list here. There's no real significance to me clicking here when you see me go back to this window. It's just this way the next indicator goes to the bottom of the list. It doesn't really have to be that way, but just a habit. Okay, so we go to daily open high-low close, click on add. And if you go to settings with daily open high-low close, you'll see that there are a lot of inputs you can pick from. Let me expand this so you can see some more of them. The biggest one is this number right here, reference days back. So reference days back means, are we looking at, how many days ago are we looking at for the daily open high-low close? The default is 1. So that's what I would consider to be like the previous day's high and the previous day's low. So if I push apply, it's going to put those lines, you'll see them in the background here, but we're going to filter some of these out because I don't want all this data here. I want to definitely have it cleaned up a little bit. So if we go to subgraphs, we can then remove stuff we don't want. So for the open, I'm going to take the open off. I don't care about it. So I'm going to change the draw style to hidden. The close, I'm going to take that off, change the draw style to hidden. And then for the high here, I want to see the value, but I also, as you noticed in the other chart, I put a name label on it. So I think I was using P-high for the previous day's high. And then I think it was going to be P-low for the previous day's low. So we check the name and the value label. So it looks something like this. Okay, so there's previous day's low. And let's just check I think those were solid lines. Yeah, those were the solid lines. So the bright blue and the magenta. So I'm just going to go into the settings section. I'll just make this one this color here, and the previous day's low this color here, and push apply. And now if we expand this here, we're going to see the previous day's high and low. All right, so now we've got that here. Now, again, there's a common theme running in Sierra, and that is when you have something that kind of looks like the way you want it, don't re-add it and start from scratch every time. Just duplicate it and change something. So I'm going to do that again here like I did with the overlay. I'm just going to hit duplicate, go into settings, and I'm going to change the reference days back from 1 to 0. Which means it's looking at today instead of yesterday. So in subgraphs here, I think what I had done is I had changed the draw style to a dashed line and just taken the P for previous off here and just made it a dashed line like this. And there's the low and the high of the day. So now we've got those values here. So when you use the daily open, high, low, close study, the most important variable in the subgraphs section is going to be reference days back, which is this one right here. So this is how many days back are we looking for to get the daily open, high, low, close. If I wanted to see the daily or the high or low from 2 days ago, I could put reference days back to 2. All right, but I don't really think that there's a reason for that here. All right, so we've got that looking pretty good. If we go back to our table here, then the next things that I'm going to go ahead and add are the value area high and low and the developing value area high and low. So this is a similar idea. We're going to add it once, we're going to change the study just a little bit, and add it a second time. So if we do this here, and again, these kind of are stacking up on top of each other. So let's go ahead and make this a little taller, and let's squish these windows so they're just not as tall. We don't need this much data. And a lot of this data is going to end up coming off the screen completely anyway. All right, so I'm going to go back to studies, and let's add a study here called volume value area lines. Oops, let's see, volume value area lines. Okay, so volume value area lines, go to settings, and I really didn't have to change anything here for the first instance. So in subgraphs, these are already very clearly pre-labeled. I like to put the value labels on so we can see them, and the name labels in this case, because I like to put in my own name. So if I just let it put in its own names, it'll label them for us, but some of this takes up too much space. So what I'll do is just do VAH for the value area high, VAL, and then point of control. So I just make those changes, and the value, those very quickly simplify. Now, the only setting that you want to change for the developing lines is to just do, so again here, I'm just going to duplicate the study. And in the settings section, Sierra just has an option in here that says, do you want to draw developing lines instead of just the regular ones, which is defaulted to no, and I'll just say yes on this duplicate. And you can see now the lines are going to be there. Now they're in this kind of funny dashed format, so I think I remember making a change to the way that they looked. Yeah, that was it. So I just changed the line style here to dash. Oops. Sorry about that. Just click the help button by accident there. And so now we can see those developing lines as well. So now we've got our value area and we've got the developing lines. That still looks a little funny compared to my original one. Dash one. Okay. Well, let's see if I can make it look a little bit nicer. But that's the general idea. So we now have the developing value area lines, and we've got the regular ones. Oh no, that's not it. Okay. Well, we're not going to focus too much on the dash or dotted line. Sorry about that. All right. So we at least got that in place. Now, from here, there's a couple other things that I really wanted to make sure that we touch on, and that is the coding of the actual signals themselves. So if we go back in time here, we're going to see these red and blue arrows. This is really the guts of the study. And what I want to show you how you can do inside the program here is how you can generate first this color background, and then I'll show you how to do the color, the arrow as well. So first we'll do the color background. So in this instance, we want to be told when the market breaches the value area and the CCI is hitting this negative 200 level or crossing the negative 200 level at the same time. All right, that is really what this is all about. So what we're going to do is we're going to use a study called the color background based on alert condition. So if we go here and go color background based on alert condition, it's one of our study options. This is where we actually have to do a little bit of work to determine how to actually use this syntax that Sierra provides us in a proper format. And I'm not going to call this programming because I'm not a developer or programmer and I was able to do this. But there is a little bit of effort you have to put in just to understanding the basic greater than, less than sort of language that Sierra uses. So in this example, what you want to remember is that every study has an ID number, and every study has a series of subgraphs. So the ID number for the CCI is ID1, and the CCI is SG1. So the way you would identify the CCI itself would be ID1.SG1. And in the context of the lines themselves, like the upper line, the 200 line, and the negative 200 line, those are identified by SG3 and SG4. So if we were to sort of put this in English, what we'd be saying here is when ID1 SG1 crosses or is below ID1 SG4, which is the lower 200 line, that's part of our buy signal, right? So that's the first thing I want to put into the code here. So in the alerts section of the color background based on alert condition, what I want to first do is use the first part. So we're going to say ID1.SG1, which is the CCI, is less than ID1.SG4, which is the lower line of the CCI. All right, so if we were to just apply this without doing anything, we are simply going to be told by the chart when the CCI is less than negative 200, which we can see an immediate response here. All right, so again, the CCI is ID number 1, and in the subgraphs tab, you can see that there's a subgraph 1, which is the CCI itself, and then this line here, line 2, as we can see in settings and inputs, represents plus 200, and line 3 represents negative 200. So the line 3 value is SG4, and the CCI value is SG1. So the way that code sort of works out is really just one is greater than the other, or in this case less than. So the CCI, ID1.SG1, is less than ID1.SG4. We are simply being told by the chart to show the background color when the CCI is less than negative 200. Now, just to make this look a little bit more familiar, we'll put my color on it, which I think was like this, and this is half the battle. But we don't want to be told when the CCI is below negative 200 on its own. What we want to be told is when the CCI is less than 200 and the market is ripping through its value area low. So the next thing that we have to do in this case is go and find what those values are in terms of the subgraphs that they represent. So volume value area lines, I always was using this first instance of it, the one with the solid line. So volume value area lines, we can see that they've got their own subgraphs. So this is ID8, and then the value area low is SG3. Sometimes it's helpful when you're getting into all these different things here to write, to jot these down. Sometimes I do this from time to time. So ID8.SG3 is the value area low, and ID8.SG2 is the value area high. So in this case, I want to know when the market price itself is going lower than SG3 from above. So I want to see when the market is coming down, 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 down through the value area low. In the same time, the CCI is going to negative 200. All right, so let's just go ahead and cancel out of here, and we'll go to the color background. And we're going to incorporate this. And what you're going to see is that when we successfully add this, these lines are going to go away because this doesn't happen that much. So we might have to scroll back in time to find another instance where this was occurring. All right, so the way to do another condition here is to separate these by a comma. And we're going to use a little operator that Sierra provides us called cross from above. So we're going to use cross from above. And there's a whole listing of these on Sierra's website. We've got tons of videos on them, so don't be intimidated. There's not that many of these. Cross from above, cross from below, crossover, greater than, less than. There's not much more to it than that. And these coding looks a little bit more intimidating, than it actually is when you piecemeal it. All right. Okay, so cross from above. So what we're going to be doing here is we're going to use the letter C as the operator for the current price or the closing price of a bar. So anytime you're referring to the price itself of the market, you're using C. So we're going to do cross from above, C, comma, and then we're going to use the study identifier that represents the value area low, which is ID8.SG3, like this. So there's two separate conditions. There's the CCI being lower than that negative 200 level, And then there's the market going through the value area low from above, cross from above, and then you open a parentheses and put the two items in order. Current price crossing from above, ID8.SG3. This VAL has to go away. Sorry about that. I didn't mean to copy paste that in there. So if I apply this, you're going to see that those lines went away. In fact, oh, you know what? There's something I forgot to do that was really obvious. When you're using more than one condition like this, you need to encapsulate the entire thing with one big old parentheses with the word "and" in front of it. This means that both of the conditions inside of the "and" parentheses have to be true. So if I were to show you this code, like you just walk into the webinar and this is the first thing you see, I can understand this can be confusing, but when you are piecemealing it together like this, it's not that hard. You just have to, talk through it in your mind a couple of times, and it comes really, really naturally the second and third times. So if I just apply this here, we don't get that error log this time, I can assume that this is successfully implemented. And the way that we can test for that is to go and look at those colors. So here's one right here where we can go back and look to see if it's right. All right, so the market goes below the value area low. And then at the bottom, you see here the CCI hitting negative 200. All right, that's a little bit tricky because that's right on a new day. But here's another example. So here's the market going below the value area low, which is this line right here, and the CCI is negative 200. So this is where you would get that buy signal. So in this case, I only have the background. I don't have the arrow up here too, but we'll show that in a second. Now, just to kind of show you how you can sort of flip side this with the sell side without doing a ton of work, is when you go to settings, just like we were doing before, you can just really duplicate the study. You just have to understand that we got to change a couple of things. So when we go to the upside, like the sell side, we want to look at when the CCI is breaching this upper value of positive 200, and the market is going through the value area high, not the value area low. So we need to make sure we substitute this new value in there as well. So I'm just going to go ahead and duplicate the study and go to settings. And we're going to mess with these lines here a little bit. So I don't know if you remember, but the CCI is ID1, SG1, and the upper line was SG3. So I'm going to make this SG3, and we're going to flip this less than sign to a greater than sign. So now this says when the CCI is greater than the upper 200 value line, and we're going to change this operator from cross from above to cross from below. And we're going to use, instead of the value area low, we're going to use the value area high, which is SG2. So you just kind of go in and sub out a couple of things and flip your colors. And we push apply. And I'm hoping we see a result. Let's see if we get one here anytime soon. There's one. That's right on a new day, though. So again, that's a little bit tricky. See if we can get another one. It actually only defaults to show 2,000 bars back, so we're not going to see that many examples, but they will be there, and they will develop in real time as well. So that's the one we were just showing, but yeah, it's not a great example, but it's still true. Okay, it's when the market breaches above the value area high and the CCI is above that 200 level, then we get this red background color. All right, so you can start to see it sort of come together. I mean, I know this is a ton of information, and this is not an easy concept. I mean, I'm not a mathematician. This is just a way that this is just one way of looking at things. And my goal is to really simplify the screen. And that's kind of ironic when you look at what you see here for the first time. But let's go through, I want to go through a couple of other, we're not going to have time to go through every single thing here. So I'm going to actually zip over back to our pre-made example. And I'm sorry, we're not going to have time to go through the entire thing, but I want to touch on a few other things first that are really important to this idea. All right, so this percentage change thing, this gray area, this is a really simple color background condition where it's looking at this subgraph down here. So if anybody wants to see that, I'm going to actually defer that to yourselves if you get a copy of the file from me. But there's a color background condition where we're getting this background color if we see a -1 value for this line. I know I'm just blazing through it, but there is a general concept that I want to illustrate here as well. All right. And that is that this chart that I'm about to display right here is really the same chart as all these other things without all the stuff. So the end game for someone who has a decision fatigue problem where you're looking at 20 different indicators and all the time frames and all the markets is to simplify the amount of info that you are having displayed on your screen all the time. And one way to do that is to use the hide function that exists in Sierra's studies window. So if you look at this window, you can see that a lot of these studies are hidden. So the CCI is hidden. The value area lines in this case are both hidden. All right, the bid volume versus ask volume at the bottom is hidden. The net change or the percentage change for crude oil at the bottom is hidden. So there are situations where looking at the trend of a moving average or looking at the trend of a CCI or something you could argue are useful. In this case, you probably wouldn't want to hide those values. But you can imagine that if you are pretty confident that you've got a series of filters that are working, that you don't necessarily need to see all the guts of each of them all the time. And if you don't think that that affects you by 9, 10 o'clock in the morning, I just disagree. I just disagree. I mean, there's too much information. The technology is getting too good. People have access to more and more stuff. It's problematic for most people. So this chart is just not as hard to look at. You got a weekly profile. I can easily see where the major interest rate and energy benchmarks are. I can see if there's a ton of volume hitting the market in one direction or the other with the order flow. And I can see the previous day's high-low and the current high and low. And to me, there's just not much more that I need to make a decision, except I like to look at this on more than one market at the same time. And one reason why I like to do that is because, especially with the NASDAQ, the NASDAQ, you got to be careful with because that thing will run, and when the other markets are not. But that's just about watching the relationships between the different indexes or different markets on a day-to-day basis and how they disjoin and then rejoin. Is if you are looking for a short signal and you see this sell signal happen on all 4 of the indexes at the same time, that is a mistake to sell that market, in my opinion. So this whole thing is very, very contextual. That's why you can't just look at the chart and be like, oh, well, this is definitely a clear buy signal and this was definitely a clear sell signal. You really want to be cognizant of what else is going on. That's why I added crude, and that's why sometimes I remove crude. And that's definitely why I look at the major indexes all at the same time, because you could actually argue that if you were looking at this screen and you see a sell signal come up, or a buy signal come up on all 4 of them at the same time, which means the market is breaking down, especially if it's breaking down violently, and all 4 of these trigger a buy signal at the same time, you could almost argue that that's a sell signal, right? I mean, that means momentum on all 4 of the indexes has broken, and especially if it happens later in the day, because remember, this value area is accumulating volume throughout the day. As the day goes on, because each contract means less and less to the average, if it breaks out of its value area high and low late in the day like it did today, that signifies some strength. Conversely, you could also make the argument that, on a low volume day like this, it doesn't really matter that the market was breaching its value area high, but that's a pretty strong close. If you look at all 4 of these indexes and the market closed near the value area high of each of them or above it. So this is a very contextual, way of looking at the market. And what I really like about Sierra is that Sierra allows someone who is, again, not a developer like me to put something like this together based on my own volition without hiring someone to do it. And I'm not saying that there aren't great people who provide tools for Sierra. There are, many of whom we work with, but we don't just let everybody in the door like some of our competitors where, where there's literally no or almost no vetting of that particular vendor. A lot of the groups that we work with that we allow to put these sorts of tools in front of our customers, they're in the room every day. Some of them are in the room all day with their customers. It's not just like selling some magic tool. All right, we're opposed to that idea. And that's the reason why, we're trying to show people that this can be done without having to go out on the indicator circuit and you get stuck in an ecosystem through a competitor of ours that you'll never get out of. It's just really, really hard to get out of it once you're in it. So I'm going to sort of leave it there only with this particular setup. Before I go to some of the other things that I just want to show you very briefly, does anybody have any questions about any of the mechanics or this concept? Before I move on, there was a couple of questions with the bid volume, ask volume stuff. The problem with the bid volume and ask volume on such a small time frame is that in the beginning of a bar, it doesn't take a lot for the signal to be valid. So if you're looking at a new 5-minute bar and all of a sudden, 5 contracts hit the bid and then 20 hit the offer, the signal is valid because it's only looking for a multiple of 3. So you can solve that by putting a floor on the number of contracts that have to trade at that price or in that bar before the signal becomes valid. Like you could say something like with the S&P, okay, we want to look for the bid volume to be a factor of 3 of the offer volume, but only if we've already traded 5,000 contracts. Like that you could do. The only problem with doing that is that you have to use a different value for every market because they're all different, and you also have to use a different value for every time frame. So if you like to change the charts or switch back and forth between stuff, you're constantly finding that you have to rewrite the signal. So the bid volume versus offer volume is something that I have found to be a little bit more problematic, on something when you're trying to simplify it this dramatically. Okay, we will have this recorded, folks. It is going to be on it'll be on the YouTube page within a couple days. All right. Right. Okay. So I'm going to move on to a couple of other examples, but there were, John, you asked about why CCI and not the RSI or something else. No reason. The CCI is something I've learned about through, some of the groups we've worked with in the past. I was looking for something that didn't happen all the time, and something that didn't sustain a value that high all the time, and it just jumped out at me. That's all. Yeah, Tom, thanks for that comment. Much appreciated. All right. Okay. Chris, no, there's no way to hide the entire region based on the value of the chart. You might be able to color the background of a certain region the same color as the line or something like that if you really wanted to find a workaround. That's probably possible, but no way to hide the region entirely based on that value. Okay. Ray, the reference on this chart to the order flow are these blue and magenta dots up here. But I'm going to show something else. I'm not going to go as far into it, but what this is basically doing is showing when the bid volume or the offer volume is eclipsing its counterpart by a factor of 3. So basically, if the offer is getting slammed versus the bid, you get the blue dot. If the bid's getting slammed versus the offer, you get the red dot. So you're asking the charts to parse out the bid volume versus the ask volume like it's doing automatically here, and then let us know when one of those values is eclipsing the opposite by a certain factor, in this case 3. All right, now let's move on to a couple of the other examples. So volume profile, this is a completely different screen. I have a different color setting theme and everything here. Volume profile is a pretty strong part of Sierra. So if you like some of these ideas, but you rather see the actual profile all the time, instead of just the pieces of the profile that I was looking at, like on my version, besides the weekly profile, which just gives me a quick, really the weekly profile is great for looking at the weekly high and low. So if it's Thursday and all of a sudden the market's going near its upper end of its weekly profile, there's going to be a flurry of activity. You can bet your behind you're going to see some movement up there. But this is a weekly profile. So if you prefer to look at profile on a daily basis, Sierra has a lot of strong points for that. And what I was doing on my chart was only showing the value area lines, like the value area high, which would be like this blue line, and this blue line is the value area low, and then the point of control, which is the pink line. All right, mine was blue. All right, some people like to look at the actual profile, and they like to look at these peaks and valleys, and they like to see where they intersect, and like Ted and a couple other people here are really into market or TPO profile or volume profile. They like to look at over a period of time of where these things are lining up. I mean, there is this is like a straight shot all the way through. I mean, this is something that a volume profile person will notice. All right, so this would be a good example of either a choppy system probably working pretty well during this time, or the market is coiling up for some major volatility because there just hasn't been a huge range, since way back here. So that's how someone might see this. So Sierra chart does allow you to use volume profile as well as two split profiles for one session. So if you right click and go to studies, you have the ability inside Sierra to split the profile so that you get one profile for one session and another profile for a different session. So in this case, in the chart settings section, we actually have this evening session here where we get one profile between 8:30 and 3, and then another profile between 3 and 8:29 and 59 seconds in the morning Chicago time. So this is definitely a 100% available. Ted, what I was saying earlier is that I just don't use this in my example that I was looking at. This is definitely here. I'm going to show you a couple other neat ones as well. But when I'm looking at that chart, I'm looking at more traditional indicators like CCI, and this stuff just distracts me. So I really only care about the volume, the point of control, and the value area in my example, but not everybody does. That's all. All right, so this is the volume profile. So this is an example. So if you would like a copy of this to work off of, this is a pretty cool example because you're going to get a weekly profile that's going to take up a big chunk, and then you're going to get intraday profiles times 2 for each day, excuse me. And the only thing you really need to do is adjust your chart settings to reflect the correct times for your local time zone. So you want to make sure these are correct. All right, I'm going to push this disconnect button up here because our system's going into its maintenance period, and it's going to be trying to reconnect for a few minutes here. So we're going to wrap it up in a minute, but thanks for sticking with me. Just a couple other things I wanted to show you. The other is, for those of you who do like to look at a more traditional TPO profile, this is a TPO profile chart inside Sierra. It's got its own color scheme. I made it. We also have a volume profile that goes along with the TPO profile, so if you like to see them side by side, you can. The reason why people oftentimes like to look at a TPO profile and a volume profile side by side is because the points of control can be very different. Oftentimes that's the case when the market stays stagnant at a certain price at nighttime, where it's sitting at a certain price, therefore it's building that TPO letter accumulation here because it's sitting there, but it's not actually trading a lot. But then the volume profile actually shows the actual volume traded. Some people combat this by only showing data for the US session, but I like to look at the entire session. So that's one reason why people look at both of those. So you definitely have access to a full TPO profile and volume profile or combination thereof as a customer of Infinity. Anybody who wants, again, a copy of the files, just email your rep directly. Don't message me here just because I'm going to forget, because there's a lot of people here. So if you want a copy of these files, just request them from your rep and we'll get them off to you. And remember to adjust the time settings if you need to. All right, mine are set in Central Time. Another one that I wanted to show was this order flow example. So Ray, a couple other people were asking me about an order flow example. This is a chart that I made after a customer of mine asked me or told me he was about to buy this very similar setup for a competitor's platform for $2,500. And I was like, okay, let's pump the brakes for a minute and see what we can't figure out. And what we're basically seeing on this screen here is a volume profile. Okay, it's got some fancy colors. I was trying to make it look like the other one. And we've got what's called a numbers bars chart here, where you're seeing actual bid and ask volume inside the candle like this. So you can see the number of contracts traded at each price on the bid side and the offer side. Okay, this is sometimes referred to in the trading community as an order flow or a bid volume versus ask volume or a footprint style chart, something like that. All right, so this is what this is also a stock indicator in our program. There's no reason to go out and buy this. Okay, on the right side here, this is a measure of market depth. There we go. Like I said, we're going in our maintenance period here. This is a measure of market depth here, so you can see, the number of contracts that are on the bid or the offer in terms of the DOM, the depth of market. So if you care about that, that data is readily available. And then also all these crazy lines you see, the blue and lines. Has anybody heard of the concept of an unfinished auction, where there's there's a number greater than 0 on one side of the bid or the offer at one of these numbers bars? Okay, so unfinished auction. That's what this is basically showing. Is so what you're doing is you're getting, when you look at the bid or the offer volume at the top of one of these bars, you're going to see scenarios where there's not a 0. And so the argument that there is that some people refer that to as that's unfinished, or the market needs to go back there to for the rest of the orders. Or that it's likely to. This is an extension line that goes off into the future until that line is again intersected. So that's why you see some of these blue lines coming across and then stopping here. And then you see this orange line going all the way across. This will keep going until the market reaches it again. So, if this is something that you're interested in, and you can see down here, there's values based on the bid and the offer, delta, the range of the bar, all this stuff is available. Again, I'm not a huge fan of getting this granular with this data, but that doesn't mean it doesn't work for you. If you feel like this is something that you can make work in a real environment, then use it here instead of buying it from someone else for 5K. That's all we're trying to say. All right. Right, Andrew. So this is like the same thing. I mean, this is a candle. This is a candle. This is this is the high and this is the low of the price. So there is the ability to like have a candle and circle it, but ultimately it's the same deal. Like this right here, these little green bars. What Andrew's asking is there's another company that makes an indicator where this looks like a candle. And this is, you can do that here, yes. But in this example, these green bars mean this was all body. Okay, like these green bars here mean that the fact that they stop here and they stop here, these would be the wicks. Okay, so if you go back and you're going to see more and more examples of this. Like here, this would be the body of the candle, and then this is the wick. So it's just a visualization difference, but it's the same thing. But you can't actually put the candles in there, all right? Yeah, David, that's correct. Yep, that's exactly right. All right. Okay, so yeah, this is a good example of the order flow. And then another thing that I wanted to touch on before we sort of wrap things up is we are working more and more on helping people create spread charts, and we're going to be releasing some really cool add-ons that we've built only for Infinity users that will allow you to easily manage spread positions or even enter or exit spread positions based on either price values or ratios. So a really crazy example of the spread market and why, if you're interested in pairs trading, we're going to do an entire event on this coming soon, but we've had a lot of interest in this idea lately. And this is an example of a chart that we built that shows the current price. It also shows the price of a market overlaid. And then we can see the difference between the two, just arithmetic, and then we can see a ratio and a moving average of the ratio. So if you're interested in relative strength charts where you're looking at pairs trades, this is certainly something that you could use here with us as well. And so what this is crude minus RBOB, and RBOB is gasoline. So as you know, with the hurricane, you probably saw the price of gasoline is spiking, and RBOB specifically is rallying big time. So this is a good example of how you can see a market that is normally tracking its counterpart, and then due to something like what we saw with the hurricane, the price of RBOB spiking. So spread trading is not necessarily less risky as a result of these sorts of anomalies and other possibilities, but we've seen a spike, no pun intended, in the amount of interest that we've had in this type of trading. And I just wanted everybody to know that we are improving actively our tools for Infinity users who are interested, and we honor exchange recognized spread margin. So if you hold a position through the close where you're long one market and you're short another one, as long as it's an actual recognized spread at the exchange level, we will automatically apply margin discounts to your account. If you're a user of, let's say, TradeStation or Thinkorswim or something like that, very, very unlikely you get that spread credit. And they can be significant. So as an example, like with the 30-year bond against the CME's Ultra bond, which is like the ultra long bond, that spread together is only about $1,500. But if you're margining the positions separately, it could be like $7,000 to $10,000 based on the current values. So the values are not even close. That's why we're making such a big deal of it. Okay, so that is definitely something we're improving our facilities on, and we're listening. So we love the feedback. We are actively involved in what our customers are looking for, and I hope we're able to relay that to you with this type of a presentation. And I certainly hope you ask us for access to the files. So if you don't have a demo account with us yet, you can get one on our website. Just go to infinityfutures.com, right on the main homepage, and you'll see a Learn More section or the Infinity AT Trading Platform section. You can just put your info in, click Submit. You'll get an email with the user ID and password and a download link. I'll put the link in the chat box here if anybody wants to check it out. But if you're an existing customer or a demo user and you want a copy of the files that we made today, just send an email to your rep in our office. We'll get them over to you. And if you're not using us yet, or you're thinking about it, or if you're using our trading platform but you've never really cared to look at the charting, use this as an opportunity to get involved in our charting. It's free if you do a minimal amount of trading with us, 10 round turns every 30 days. Otherwise, it's only 20 bucks anyway. So it's not a huge amount of money, even if you're not meeting our relatively modest volume requirement. Okay? Okay, good deal. Well, thank you everybody for taking the time. If I missed anything, just send a quick email to my initials, pz@infinityfutures.com. I know there's a lot of questions I missed, but we're running a little bit late on time here, so I do have to close things up. But pz@infinityfutures.com is my email. If you have any buddies or trading buddies online who might be interested in this kind of thing, hopefully you can send them the recording or refer them over to us. We'll get them squared away as well. Very much appreciate your time. Thank you so much for listening. I'm going to read through some risk stuff here one more time before we wrap things up, and then we'll have the recording up on YouTube hopefully within a day or so. Okay? All right, folks. Thank you very much. Appreciate your time. We'll see you next time. All right, folks, trading futures, options on futures, and retail off-exchange foreign currency transactions involve substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. All right, folks, keep your eye on your email for a YouTube recording, and off we go. See you next time.